afternoon, and it's a pleasure to be back at Flame after more than 2 years. I thank Durgesh Bhai and the entire team at Flame for this opportunity to interact with you this afternoon. Before I tell you, by the way, I'll keep moving here and there because that makes me less nervous. I hope you don't mind. Before I tell you what I intend to speak about, I will first tell you what I do not intend to speak about. I am not going to give you some fantastic insights about investing, because I am aware that there are people in this audience who are far more accomplished in the field of investment than I am. So I am not going to attempt giving any insights. Nor am I going to predict how the stock market, how much Nifty is going to be in the next 6 months, or for that matter, the Dow Jones index, how much it's going to be in the next 6 months, or US dollar rupee exchange rate, how much it's going to be, interest rates. I'm not going to attempt to read the mind of Mr. Shaktikant Das or Jerome Powell, because I have no clue. Also, I'm not going to talk about modern investment items like cryptocurrency, the pros and cons of Bitcoin vis-a-vis Ethereum, because I have no idea. So let's get that out of the way. What I intend to speak about are some issues that confront a portfolio manager in his everyday life, his or her everyday life. And this comes out of sheer experience, nothing more than that. I want to share them with you. I want to get your inputs and learn from it. That's the purpose of this presentation. Like a good fund manager, let me begin with disclaimers. The points raised in this presentation are mine alone. Opinions are mine. They don't represent any organization's opinion. That's one. I'm going to raise questions, but I'm not going to provide any definitive solutions because there aren't any. Right? What is good for me may not be good for you. So I'm here to learn about what is good for you. I realize and acknowledge that there can be more than one answer to each question. It's possible. And whatever examples we'll discuss are given for illustrative purposes only. So with these disclaimers out of the way, let's begin. What is the purpose of this presentation? Why do I want to make this presentation? My purpose is, I want the investment management world to come out of the cycle of what I call the outperformance karma. You know, we are seeing this every day. Any fund manager, let's say he'll have a period of underperformance, then he'll buy one or two sectors or select stocks in one or two sectors which hit a purple patch, right? Then his performance goes up, he becomes close to number one, then he's praised to the skies, the media projects him as a demigod, right? He's interviewed by various people, most notably by CNBC, ET Now, etc. His views are sought on almost everything. Distributors love him because it is easy to sell a product that is close to number one. Then the very reasons that made him number one will be the reasons for his downfall. Overconfidence will set in, and he will not change the kind of portfolio which has built and worked for a particular time, but the times have changed. And then that leads to lax risk control, and then leads to underperformance again. We have seen this several times in the last 25 years. In 1999, in the technology boom, in 2007, in the infrastructure real estate boom, in 2016, in the mid-cap boom, in 2018, in the NBFC and housing finance company boom, and more recently, in what I call the quality at any price boom. Yes or no? I don't know whether it's possible to break this cycle. I don't know whether it will happen. But I have the right to dream, right? And my request is, for the next 40 minutes or so, please dream along with me. These are the questions which I want to raise in today's presentation. In investment products, who is the best? And more importantly, does that matter? I feel very strongly about this. And I'll explain to you how this thinking evolved and the reasons behind this sort of thinking. The second point is, there is so much focus in the investment world, not just in the distribution community, but also the media, mainstream media, about the intellect part of investing. Intelligence, analysis, what is going to happen next, and so on and so forth. But very, very little attention to the temperament, building a sound temperament for investing, which I submit to you is at least as important, if not more. The third and my pet peeve is about predicting the future. It is almost taken for granted that the fund manager's main responsibility is to predict what is going to happen. It is not true. The fourth point is a portfolio just a collection of best ideas? I don't think it is. I've seen many people just say, and best ideas are usually defined as the ones which have the potential to give maximum appreciation. Is it just a collection of best ideas, or is the portfolio more about balance? We'll talk a bit about that. Handling periods of underperformance. Like it or not, all of us are going to underperform at some point of time. The trajectory of underperformance will differ from person to person, but all of us are going to underperform at some point of time. How to handle that period of underperformance is something that I want to talk about. How long to wait for a stock that does not perform? It's a very familiar problem, right? I think Akash mentioned it in the morning's presentation. If you're managing your own money, it doesn't matter. But if you're answerable to somebody else, beyond a point, it does matter. I'm not talking of 1 month or 2 months, but what is the reasonable time period to be patient with a stock that doesn't move? That's something that I want to discuss. How much cash is appropriate? Do we pre-decide that this much cash is needed for the portfolio? How much cash is appropriate? 25%? 10%? 5%? 0%? This is something we should discuss. It is said that the stock market is about the future. But should we forget the past? Is the past completely irrelevant when we discuss the investment in stocks? How much to pay? When do we conclude that a stock is too expensive? That is one discussion which I think is important. How much to buy? The sizing of each stock in the portfolio. I want to spend a few minutes on that. And finally, and I think the most important is, how do we align the client's interest with that of the portfolio manager? These are some of the questions I want to raise. As I said, I'm not promising any definitive answers to any of these things. The first point, who is the best? And more importantly, does it matter? I'm going to use some data provided by Motilal Oswal Wealth. It's very interesting. It's not completely updated till 2022, but it will serve our purpose. They have taken the mutual fund as a proxy for the investment world, the mutual fund industry, because the data is available there, right? This is very interesting. See, this is the ranking of mutual funds from the period 2009 to 11, for a 3-year period. Then how that particular fund has performed in the subsequent 3-year period. The number one guy in 2009-11 was 162nd in 2012-14. The number one guy in 2012-14 was 20th in 2015-17, and the number one guy in 2015-17 was 132nd in 2018-20. This is, I could not see any pattern at all. It's completely random. You take the 10th best. 10th best here is 37th. 10th best here is 43rd. 10th best here is 200. 10th best here is 59. Who is the best? And there is so much emphasis on the top performer, the top quartile, in choosing which fund you will invest. Yes or no? Because it is easy to sell a top performing fund. After that, you can blame the fund manager or you can blame SEBI, right? For not protecting the hapless investor, you can blame SEBI. But while choosing, you have to choose the best because it is the easiest to choose. Number 7 was number 6 in this period, right? In this period, if he is number 6, 2012-14 he was number 6. 2012-14 he was number 6, 2015, next year also he was 6. But this 6 became 201.
Number 7, not 6.
No, but it changes every year.
You should have had the foresight, sir, to choose the 7th best on that year. Let's look at some more data. Again by Motilal Oswal. If you are in the top quartile, there is a 32% chance that you will remain in the top quartile after 1 year, and there is a 31% chance that you will remain in the top quartile after 3 years. Even if you are in the top quartile here, there is a 23% chance you will go to the second quartile, 21% chance you will go to the third quartile, 23% chance that you will be in the bottom quartile in the next review period. What are we talking about? Who's the best here? See, the best is important only in a bull market. In a bear market, nobody gives 2 hoots about who is the best, right? So they don't invest anywhere, correct? They stay away from the market totally and wait for the market to show signs of turnaround before coming again. Yes or no? But look at this. Being number 1 in a bull market, what does it really mean? In a bull market, if you're number 1, you are overweight on sectors that are already dangerously overvalued. Yes? What happened in 1999? We'll discuss more of that later. What happened in 2007? I mean, people were loaded up on real estate companies and infrastructure companies and so on and so forth without bothering about the quality of the balance sheet. Anything that moved, people bought. Right? So this anxiety to be number 1 is counterproductive. That is the point I'm making here. Let's look at the environment under which we are trying to be number 1. It's very interesting. There are hundreds of portfolio managers. All of them have been blessed by the Almighty with equal amount of intelligence. How much of it they use is a different matter. But all of us have been blessed with roughly the same level of intelligence. All portfolio managers are equally well qualified. Everybody is an MBA from a top school. Everybody is a rank holding chartered accountant and a CFA charter holder. So there is nothing to distinguish one person from another in terms of educational qualifications or intellectual ability. There is nothing to distinguish in terms of the availability of information. Everybody has Bloomberg nowadays. Everybody has modern computerized databases. Everybody attends the same analyst meet. Everybody reads the same conference call transcripts. Everybody reads the same annual reports. Everybody reads the same newspapers, magazines. Everybody watches CNBC or ET now. Everybody is trying to predict the EBITDA margin for the next 2 quarters. And nobody has a clue. Is there anything wrong in what I'm saying? Because the factors that govern the stock price movement are too many for us to control. Here also I think Akash made a beautiful point in the morning. He said just look at the 4 or 5 factors that really matter. Don't try to control the world, because there are hundreds of variables over which you and I have no control. Just look at the 4 or 5 important factors which you think are important for you. I think that's a very important and relevant point. Why am I saying this? Why am I having this feeling about this number one business? There are reasons for it. You know, Durgesh Bhai said that I worked along with the team at the Zurich Mutual Fund, which was taken over by HDFC. You know, today there's one of the most popular funds of the country, one of the most well-known funds, is HDFC Flexi Cap Fund. 27,000 crores assets under management. In those days, it used to be called the Zurich Equity Fund. We used to manage it together. Prashant Jain, Chandresh Nigam and myself. I remember this, in calendar year 1999, the peak of the technology boom, that fund generated 160% return in 1 year. But it was not considered good enough. 160%. Why? Because there were funds that had taken even more aggressive exposure to technology. There were funds that took 90% exposure to technology, 95% exposure to technology, and they had given 250% return also. Now, this is when I started to realize the futility of being number one. If 160% in 1 year is not going to satisfy the investment community, nothing will ever satisfy. There is no such thing as enough money, right? I can give you more examples. The portfolio that I managed in 2014 generated 85% return. Not good enough. Because there were people who generated 100%. Whatever you do, ladies and gentlemen, there will be somebody who will be doing it better than you. So this attempt to be number one is a futile exercise. It doesn't work. One more example, something closer to recent times. You remember this pandemic-induced panic in March 2020? At that time, there was a very sharp fall in the market. Everything had fallen. I was speaking to a friend of mine. He said, "Boss, life is gone. What are you doing?" I said, "I'm buying." "What are you buying?" One of the companies I was buying at that time was Titan. He asked me, "Why? People are going to die. Who will buy jewelry?" That was his point. I said, "Boss, I don't think that in this country at least in our lifetime, the demand for jewelry is going to go down in any appreciable manner. And Titan is a strong balance sheet. It's got a great brand. It's got a great distribution network, good return ratios. And it had come down to less than 900 rupees at that time. I thought it was a good price." I don't think he bought. That is a different issue. But the more interesting point is, the same guy I met a few months ago. At that time he tells me, "Oh, you told me Titan, but XYZ company has given more returns than Titan." from March 2020 to March 2022, Titan had given nearly 200% return. But he compared it to some other company which had given more return. If 200% return in a stock like Titan doesn't satisfy, what will satisfy? What will satisfy you, yeah? And look at the beauty of it. That guy was afraid of buying a stock like Titan. And he's ridiculing Titan 2 years later. So this concept of number one, this concept of generating highest returns, it is my fervent wish. As I told you, I don't know whether it will succeed or not. It is my fervent wish that this asset management business comes out of this number one business. It is harming the industry. That is my opinion. We are dreaming, I know, but let's dream. I think that being good is really better than trying to be the best. What does being good mean? I think it is important to say and do the same thing. Actually, this asset management business, in my opinion, consists of only three things. Clearly defining what you are going to do exactly the same thing, and periodically reinforce to the client that you are indeed doing the same thing. That's it. Even if there is an underperformance, you should not deviate from it. An underperformance will be there. For everybody, underperformance will be there. Focus should be on managing the risk and reducing the risk wherever possible and not on maximizing the returns. And some non-measurable things which can't be made out in 1 or 2 days, but over a period of time, culture and ethos of the organization. What is the lifestyle of this portfolio manager? Is he too flashy? What is his spending habits? Whom does he move around with? Does he read well? What sort of books he reads? These are things which you can't make out in 1 day. But I think they are very important. This is another pet topic of mine. Does intelligence matter more than temperament? What is temperament? See, almost the entire narrative of the media is focused on how intelligent or perceptive a person is. Just look at the interviews on popular channels. They want to appeal to the intellect. Nobody talks about building a sound temperament for investing. Nobody. Very, very few. I won't say nobody, very, very few. Predicting which is going to generate the highest return, which sector is going to do well, when will it do well, predicting the future of stock market movement or currency movement or commodity movement or whatever movement it is, you have to predict. What is going to be the expected earnings growth? All of these things. Very, very less attention is given to staying calm in times of a panic. Isn't that important? Staying vigilant when valuations go through the roof. Isn't that important? Now, the sensationalization of the investment world is actually leading to suboptimal results. That is my crib about this whole thing. Now, there is a quote from the great Warren Buffett. This guy is a fountainhead of quotes. There is one which I found very, very appealing and I want to read it out to you. We don't think we are smarter than the others. We just don't do stuff that we don't understand. And we won't be jealous when others do well. That is what it's all about. I think it is so important that I'm going to repeat it. We don't think we are smarter than the others. We just don't do stuff that we don't understand. And we won't be jealous when others do well. That is what it's all about. So simply said, but it's so important. You may think it is all theoretical and it will not apply to this country, etc. But I am privileged to have known a person who lived just like this. I think for all of us, Chandrakant Bhai Sampath was our guru. He lived exactly this way. In 99, I remember speaking to him. He only stuck to the circle of companies which he understood very well. Companies with high return ratios, high cash flow generating capabilities, low capital expenditure, and he stayed away from most of the technology companies. He never even bothered about how much money somebody else was making. He was happy about it. So it's this temperament. And I think this temperament is what leads to better quality returns and better quality results over a period of time. You fall less when the market falls. But unfortunately, this important thing is not given the attention or importance it deserves. One more beautiful quote from the great Benjamin Graham. Investing isn't about beating others at their game. It is about controlling yourself in your own game. Remember these memes? The last 1 year, the internet was filled with them. Buy ITC 200, target 200, stop loss 200, support 200, resistance 200. Or everybody dancing on ITC is up 1 rupee 50 paisa. Right? Patience level kitna hai? Investor in ITC, salary kitni loge? But the point is, here was a strong company. Here was a company available at dirt cheap valuations. Here was a company where the fundamentals were clearly improving. Very, very few people wanted to buy ITC last year. Yes or no? But the fact also is that in the last 1 year, ITC has outperformed Lever, it has outperformed Nestle, it has outperformed Dabur, it has outperformed Marico. This is another great one. The job of a fund manager is not to predict. The job of a fund manager is to allocate capital efficiently, given the circumstances, choose the best options available. That is the job of a fund manager. When you predict, there are two outcomes possible. Either you're right or you're wrong. When you're wrong, nobody will bother about you anyway. Yes. But when you're right, you're expected to be right the next time. And if by some fluke you're right the next time also, you begin to believe that you have some visionary powers. Right? And an articulation of a wish list is not really a prediction. That is what happens. Many times. Yes or no? It's also a fact that when you make a prediction, it is one way to pretend as if the future is in your control. The idea of an uncertain future is unsettling for many people. And second important point is, admitting that I don't know is considered weak. Well, if you don't know, you say you don't know. What's the problem? No, you are supposed to appear intelligent in front of everybody else. This is what I mean when these things are unnecessary, in my opinion. Do I predict? I don't predict. I have never predicted what the Sensex is going to be. I don't intend to start now. I don't predict what the interest rates, how much they will peak at. I don't predict whether, the 79 is really the psychological barrier of the rupee dollar rate, because it has crossed several psychological barriers in the last 5 years. 5 years ago it was 64 rupees. So every time it crosses 70, psychological barrier, 72, psychological barrier, 75, psychological barrier. So if it has crossed 5 psychological barriers, I think it could cross a few more, right? My job is to see whether within the portfolio, am I hedging against it properly or adequately? That is my job. And the why of the investment argument is far more important than the when, because the when is not in our control. See, there are some examples from my portfolio. 2 years ago, State Bank of India, nobody wanted to buy. Is it okay if we discuss individual names? Because I thought it was not. I think this is a beautiful saying. A portfolio is a balance. You can't just overload on sectors which you think will do well. I think it's not appropriate. This is the reason why several portfolios in early 2000 had 90% in technology sectors. Or in 2007, portfolios were overloaded with infrastructure, real estate and construction companies. Or in 2017, in mid-cap and small-cap stock. Of course, at that time, the mutual fund classification was not as strict as it was today. But I've known people in 2016 proudly coming and claiming to me that 85-90% of their money is in small cap. When? This was in 16-17. And in 2018, we had a big overweight positions in NBFCs and housing finance companies. So, even if that sector does very well, you have to be careful about how much of it you own in your portfolio. And the price to not doing this is underperformance, which is fine. We will underperform for some time, doesn't matter. And I think there is a very good reason why Warren Buffett's theory of high concentration does not work for everyone. Because we are not Warren Buffett. He works for himself. I mean, Berkshire is not that much answerable to other people like we are. And besides, do we have the kind of sagacity that Warren Buffett has, or the kind of holding power that Warren Buffett has? We don't. So blindly copying Warren Buffett on everything is also not appropriate. Usually the best idea is defined as one where one expects to make the maximum capital accumulation. Yes, that is how the best idea is defined. And this theory itself is suspect, because how much we make from the stock is not in our control. In 2007, 2008, did anybody predict that Page Industries is going to go to 40,000 plus? It was less than 400 rupees at that time. Or Eicher Motors, the way it went up. You can maybe identify a good business, you can identify a good stock, but how much you will make from it is certainly not in our control. I don't think so anyway. So, mechanically building a portfolio with the highest EPS growth or lowest PEG ratio overlooks the need to balance the portfolio. And the balance is balance between aggressive growth companies versus steady businesses, younger life stage companies with more established blue chip businesses, cyclical businesses with more secular growth companies. This balance is needed. Otherwise, when the fall happens, everybody will fall together in the same proportion. The root cause of all of this is the ambition to be number one always. Get rid of that one ambition. Just try to be good. I think these problems will go away. The top positions in the portfolio should be a function, according to me, of the level of competitiveness displayed by the company and expected to be displayed by the company. Number two, it's a function of the quality of people running that company. Number three, the valuation attractiveness. Number four, the liquidity offered by the stock. And number five, the exposure in that portfolio already built up to that sector. I think it's a combination of all of these things. See, all of us will underperform. All of us. The first thing to do is to acknowledge the fact that at some point of time, all of us are going to underperform. There's nothing wrong in it. If you see Warren Buffett's track record, I'm using Warren Buffett because certainly one of the greatest investors in the world. In the last 55 years, he has underperformed in 1/3 of the years under the 1/3. And we are talking of Warren Buffett. Right? In the last 3 years alone, he has underperformed the S&P 500 by 13% per annum. This is as per his own letter. Of course, we are better than this, right? We are better, yeah. He has studied only in Columbia University. We have studied in WhatsApp University. By the way, that's a joke. But it pains me. It pains me when somebody like Warren Buffett with a 55-year track record and delivering a 10% alpha per annum over 55 years is ridiculed by some upstart who has not seen even one bear market. This is what I think. I think portfolio management is less rewarding when there is a mismatch between the expectations of the client and the capabilities of the fund manager. So, enough effort should be made to get the kind of clients who agree with this style of investing, whatever style you're managing. And the client's choice is to diversify across clients, across styles, right? Not everything needs to come to us. If he is giving, let's say, 20% to an aggressive growth style and another 20% to, PE kind of investing, and another 20% to your style of investing, it's perfectly fine. Why should I try to get everything from the client? And there should be more than a routine attempt to sign up clients who only agree with our portfolio management style. And not all clients will agree 100%. So only target that part of their wallet which will complement their other investment products that they already have. And periodically, we keep meeting them where we reiterate that we are doing exactly what we said we would do. It's very important that during periods of underperformance, the level of client interaction is enhanced rather than reduced. This mistake I am seeing too many fund managers make. In a bullish time, they will talk big things, but in a bearish time, they shut up. Bearish time meaning when they underperform, they shut up. I think this was brought out by Gaubaji also. When things go wrong, just explain to them. I mean, I think most of the clients are accommodating enough, up to a point, of course, that if the manager is consistent in his approach, and of course, even if things go wrong, if the assumptions behind that decisions were logical enough, clients are accommodating, up to a point. So it is our job to go and speak to them. Two more, the same thing in that SBI example, if the company ticks the boxes, if the assumptions with which the stock was bought in the first place are still valid, and if there are no deterioration in fundamentals, or if there is an improvement in fundamentals, just stick to that company. How long to stick? This is what I think. How long should we wait for a stock to perform? Of course, the ideal is a stock that moves the next day after we bought our required quantities, but we live in a real world, right? That is not going to happen. So, I think the way I would articulate is that the managers of third-party money, our approach should be a combination of idealism about the purity of our method and pragmatism about the extent of patience an investor would be willing to exhibit. Nobody has indefinite patience. And if you see, some people are more patient, but some people are less patient. But it's all sorts of people will come to the portfolio. We can try and explain at the time of signing up, but not everybody will 100% agree with you. I am saying that 3 years is a good enough time horizon. If in 3 years' time, if after satisfying ourselves that there is no fundamental deterioration in the competitiveness of the concerned company, and there is no perceptible improvement in the fundamentals, then after 3 years we should be prepared to let go. Others may have different opinions, but this is the way I have structured my portfolio. See, when I discuss some things that went right for me, I'll also have to discuss things that didn't go right for me. These two companies didn't go well in my portfolio. I bought this after the diesel decontrol, ONGC. Even after diesel decontrol, even when the price of crude oil corrected very sharply, their net inflow into ONGC, because the subsidies were reduced drastically, was superior. Company paid good dividends, all that was there. The stock didn't move, and after that they bought into HPCL. That was a dampener for me. So I had sold the stock at roughly the same rate at which I bought it after 3 years. Another company where I bought and it didn't work out was Jagran Prakasham. Company did reasonably okay. They did buybacks frequently. All that was there. Profitability hadn't been affected. But 3 years we waited. Nothing happened, and there wasn't any great, significant, perceptible improvement in fundamentals. So we had to sell it. It's not a pleasant experience, but we have to bite on the bullet sometimes. I don't think there's any need to predetermine how much cash we need to hold in the portfolio. I can't time the market. That is not my sustainable advantage. So I never attempt to do. So holding a cash is simply a function of the availability of investment choices that I have, and it is not a function of the index level. I can show you examples. In 2000 there was a market peak, but old economy stocks were cheap. Nestle was available for 325 rupees in March 2000. The peak of the IT boom, Nestle, Procter & Gamble, even some banks, some public sector banks, Bharat Electronics, Bharat Earth Movers, all these were available at throwaway prices because they were all old economy companies. Nobody wanted old economy companies in those days. Only 3 sectors moved: technology, media, and telecommunications. This was the day of Nicolas Negroponte, being digital, all those things. Everybody was enamored only by the new economy. Bricks and mortar was shunned, but bricks and mortar companies gave very good returns even if you had bought at the peak of the technology boom. So keeping cash, looking at the index level, doesn't make sense to me because the index is not a monolithic entity. Or FMCG and pharma in 2007, or auto sector in 2007. If you had bought Maruti Suzuki or Hero Motors or things like, of course, Eicher, that is one big miss in my portfolio. But if you had bought it in 2007 and held it for the next 4-5 years, you made very decent money. Of course, the others corrected. DLF, Unitech, GMR, GVK, all these fellows corrected big time, but Auto sector did very well. Industrials in 2013-14, IT in 2017. Remember Infosys in 2017? There was this Vishal Sikka and clash with the promoter. Infosys available at 12.5 P multiple. Nobody wanted it. Divi's Laboratories in 2017. Today Divi is, after going to 5,000, it has come down to 3,500. But Divi's in 2017 was available for 600 odd rupees. Public sector stocks in 2019 and several stocks even now. So cash is not a function of what the index level is. And we don't have to pre-decide on how much cash there is to be. And if you hold too much cash, let's say 25% in cash, just for emergencies, for practical purposes, it doesn't work well because the client is unhappy. So I think ideally 6 to 8% cash is appropriate, but that need not be the same for everybody. I hold not more than 6 to 8% cash. If the stock market is forward looking, should one ignore the past? I think it's a spillover from this private equity kind of investing that comes into public markets investing, where you look at only at the narrative. It's, I think, dangerous. Too many people, especially in bull markets, give far greater importance to future projections than the past track record of the company. This Excel spreadsheet is a wonderful thing. You can create magic with it. I'm not a venture capital or angel investor, so I will not invest in a company that does not have a track record. I know that I'll miss several opportunities because of this. I'm okay with that. All my companies are oldies. The average age of companies in my portfolio is 62 years. All oldies, grandfatherly companies. The youngest company is about 20 years old. 62. I think the future is important, definitely, because you can't ignore the prospects of the company when you are investing in an equity share. But the past gives important clues about the way the management thinks, especially in terms of capital allocation decisions and the treatment of minority shareholders. And this you will know only by looking at the past track record. These are very important inputs. So you cannot ignore the past. You should not. Just as we said that portfolio management is an amalgam between pragmatism of catering to the client's need and idealism about the purity of our investment approach, here also it is an amalgam of what in the past the company has done and what it is capable of doing in the future. You can't ignore it. Again, these are my opinions only. I'm not saying everybody should follow this. Ultimately, I think the single most important job of an investor is to assess the continued competitiveness of that company concerned. That is far more important than anything else. And for me at least, it is more easier to do it in case of established businesses, not in case of absolutely new businesses. This is a recent phenomenon, what I call BAP investing. Buy at any price. If a sector does well, should you pay anything for it? What is an appropriate price? There is no perfect answer for all these things. You should do what is comfortable for you, but having no system at all is dangerous. No form of economic activity can ignore the price at which a transaction is made. In any form of economic activity, the price at which the asset is bought is considered important. And the lower the price you pay for an asset, the more prudent it is considered. In the stock market, it is the reverse. In March 2020, nobody buys. In December 2021, there is a rush to buy. I'm not talking only of allegedly retail investors. I looked at the cash position of the top 10 equity mutual funds of the country. they had a higher cash position in March 2020. 6 out of the top 10 funds I'm talking about. They had a higher cash position in March 2020 compared to January 2020. Between January and March, the index had corrected nearly 30%. There is no one-size-fits-all rule about the appropriate price to pay. I am just discussing what I think is more appropriate. I think we should look at the present valuation vis-a-vis historical average. I take 10-year average. Some people take 5-year average. I take 10-year average. And within 10-year average, I give 2/3 weight to the immediately past 5 years and 1/3 weight to the 5 years before that. So that is one way of judging. But we shouldn't lose sight of the prospects of the company in future. So I compare the present valuation to its estimated earnings growth rate. Some rough estimate, nobody can get it right. Or we look at the present relative valuation vis-a-vis historical average. I think this point also, Akash Prakash made in the morning. You can't really take industry average PE and company PE. Because Jyoti Laboratories is also FMCG, Hindustan Unilever is also FMCG. Are they comparable? And present valuation vis-a-vis discounted cash flow, that is another method, but not all businesses are amenable to discounted cash flow. One very good technique which I think is suitable and is useful for all investors is Michael Mauboussin's reverse DCF. So if you do a reverse DCF and arrive at the present value equal to the market price, you know what assumptions you are working with. And if those assumptions seem too outlandish, stay away from it. It's okay. These are only, there's no perfect system, right? These are suggestions, that's all. Usually, we take Warren Buffett for granted. Sometimes we should not. Too much of a good thing is not wonderful. Because I am also quoting another great investor here. A successful investor must possess a number of seemingly contradictory qualities. These include the arrogance to act and act decisively and the humility to know that you could be wrong. If this is true, if you agree with this, then you can't overload with any one sector or any one stock. So there should be a proper limit to which you will go. That limit can change from person to person. If we accept this as true, we cannot overload. I have been thinking about whether equal weighted portfolios are good. I think they are good for a majority of people. If you are absolutely sure about what you're doing, maybe you can have different weights. But for a lay investor, an equal weighted portfolio may not be a bad thing, provided you choose good quality businesses. How I do it is a maximum of 10% in any single stock, a maximum of 30% in any single sector, and we ensure that the portfolio always has a minimum of 4 non-correlated sectors at any point of time. Now, this is important. This is where I have some views. The fee structure in the mutual fund industry is well regulated, but the alternate investment space, there are many gray areas. There is a concept called performance linked fee. It is quite interesting, to say the least. The standard industry practice is to charge a smaller fixed fee, sometimes zero fee, fixed fee, and then a 20% profit sharing fee for any returns in a year that is higher than the hurdle rate, which is usually 10%. Sometimes it is 6%, sometimes it is 12%, but usually it is 10%. And what I find most dangerous is that there is a narrative that says that the interests of the client and the portfolio manager are aligned when there is a profit sharing fee. I can't agree with this. I'll discuss one example. In the mid 2000s, I was managing the PMS business for HDFC Asset Management. 2005 was a very beautiful year for the stock market. And there was one of the most aristocratic business families of India were our client. No names. But suffice it to say that family has been rich for several generations. That kind of family. They signed up on the profit sharing fee. At that time, HDFC had this 10% plus 20%, 10% threshold and 20% of the excess. You pay anything above the excess, you pay 20% of that. In 2005, it was a phenomenal year. The client ended up paying a huge fee. Usually, in a very good year, it is followed by a mediocre year. And the client remembers he paid a fat fee last year. Why am I saying this? Because this is evolved through experience. If such an aristocratic family found it difficult to bear that huge variable fee, what about less lucky investors? And I think it is obscene when you say that the fund manager and the client's interests are aligned when there is a variable fee. What it means is that there is an implicit assumption that the fund manager can improve his performance at will if the variable fee is signed up. That is not true. Let's look at some data. The previous 43 years in which you have record of the BSE Sensex, it has given a return of 10% plus on 26 occasions. In the last one decade alone, the market has given 10% plus on 7 occasions. In the decade 2003 to 2012, it saw 10% plus returns on 7 occasions. Assuming a 20% variable fee for all returns above a hurdle of 10%, in the previous decade itself, an alternate investment option charging variable fee would have awarded itself an average of 2.1% per annum variable fee. The biggest grouse I have against this is that the fund manager simply cannot change his or her performance for the better merely because of a variable fee concept. And this idea that I will give a better performance if there is a variable fee, that claim is certainly unethical even if it is not illegal. How do we do it at Murthy? Just a few slides about what we are attempting to do. See, investing is about either you can try to do the right things or you can avoid the wrong things. Trying to do the right things means you have to take care of hundreds of variables. Avoiding the wrong things means you just identify 3 or 4 variables and stay away from them. Because it is easier, but it is equally effective. We try to do this. We just stay away from businesses that we consider weak. We just stay away from exorbitant valuations. We'll define what we mean by exorbitant valuations. And we stay away from hype. When there is hype, it is danger. Stay away from hype. It's okay. At the most, what will happen? You will underperform for some time. It's okay. I think the compulsion to appear intelligent at all points of time is not necessary. At some point of time, you should be prepared to look like a fool. And I think looking like a fool, as Warren Buffett says, is much better than acting like one. Sorry. See, if we think that the major risk for an equity investor is permanent loss of capital, that's the only risk he ever runs. If permanent loss of capital is caused by investing in poor quality businesses, investing in poor quality managements, and investing at exorbitant valuations. So we define what we mean by a good quality business, what we mean by a good quality management, and what we mean by a less than exorbitant valuation, and stick to that. we have some, parameters. We look for companies in non-financials with a minimum of 15 years of business operations. We are not venture capital investors. For financials, we look for 25 years of business operations. Revenue of at least 5 billion rupees. Return on capital consistently about 20%. Return positive free cash flow consistency. And for NBFCs or banks, we should look for return on assets of greater than 1% and 2% for NBFCs. Return on equity should be greater than 15%. Low cost to income ratio, consistent CASA of 30% for banks. These are the parameters. And management means good capital allocation history. There is an element of subjectivity here. History of corporate governance. Market share track record. This is measurable. If the company has maintained or improved its market share, it's a good thing. If it is consistently losing market share, it's a measurable way of looking at management's quality. And expected growth rate should be higher than that of the industry growth. We are essentially looking for companies that have the ability to maintain or increase market share. Now, we will restrict the choices. At least 75% of the portfolio will be from this list. About 200 companies qualify on these parameters. There are large cap, mid cap, small cap companies. About 200 companies qualify at this point of time. And our commitment is that 75% of the client's portfolio will be from this list. Why 25% is kept as exceptions? Because some are financial companies or cyclical businesses which may be strong but will not qualify on these parameters. There may be companies which are very high on profitability but which may have a revenue of 480 crores. They will not qualify. And third and more important reason is, while it is important to be disciplined in investing, I don't think it's necessary to be too dogmatic in investing. There should always be some element of flexibility. So we have kept 25% for all exceptions put together. And then we have these risk control measures, and in terms of valuation, we look for temporary distress or distant earning triggers. These are two things that the market doesn't like usually. If the future looks bleak for the next few quarters, most people will ignore it. Or if the earnings trigger is quite distant, more than 2-3 years away, people will wait for that to happen, come closer and then buy it. That's an opportunity for somebody who has a longer time horizon. When do we sell? We sell when the original assumption with which the stock was bought in the first place becomes irrelevant. Then we sell. Irrespective of whether we make a profit or a loss, we'll sell. The second is when the price goes far beyond limits that we consider acceptable. If we bought it at less than 10-year average, if it crosses 2 standard deviations above average, or if it crosses well above the expected growth rate in earnings, we will sell. Maybe not sell in one go, we'll prune it in phases. And for the same level of perceived risk, if we spot a superior opportunity, then we'll switch. I can give some examples like switching from FAG bearings, now called Schaeffler, to SKF. That is one example. Or we switched over from ICRA to CRISIL. These are some examples. And the fourth reason we sell is when the client wants a redemption. So if these 4 conditions are not met, we are happy holding on for months and maybe years together. The difference, the way we do it differently is that we invest a new client's fund over a period. We don't invest all of it on day one. That is one important difference. Our time horizon for investment is longer, about 3 to 5 years. We ignore and look for some short-term problems that the company may be facing, because only when the company has a short-term problem, you get a good company at a reasonable price. We stay away from hype and popularity. Extreme hype, we completely stay away. These points have made our portfolio measurably different, and our overlap with the index is less than 20%. Our overlap with the top mutual funds of the country is less than 15%, and our overlap with the other big PMSs of the country is less than 5%. This doesn't make us superior, it makes us different. And the client has to mix and match with other portfolios that are available in the marketplace. That's the ideal thing to do. Now, what I would like to say in conclusion is this. There is no best investor or best investment product. So let's not even try to be number one. It's not worth our while. We have to be good. We don't have to be the best. All of us are blessed with intelligence. Some of us should use it to develop a sound temperament for investing. There is really no need to try out everything. I don't understand cryptocurrency, so I will not go near it. If you understand, please go ahead. I will not go. Predicting the future is largely a futile exercise. I think out of the situation available, whatever best choices we can make, let's make that. Predicting the future is in my opinion, useless. Maintaining a balance in the portfolio will serve the client's goal than trying to maximize the returns. Everyone underperforms at some point. It's important to remember that. We will also underperform. Deploy cash only when superior investment choices are not available. Equities are forward-looking, but don't ignore the past. Asset management is at its healthiest when the client, distributor, and manufacturer are all equally happy. I'd like to conclude with this quote from Rabindranath Tagore. You would have seen the movie Bawarchi. The title character played by Rajesh Khanna mentions this quote. It is very simple to be happy. It is very difficult to be simple. I thank you for your patient hearing.